Today I want to give you 5 reasons why the stock market keeps rising, why the economy keeps struggling, because this has been puzzling me now for several weeks, if not months, because I keep following the economic data, which is dire at the moment, and I keep wondering why do stock markets keep rising. So I did a little bit of research and I came up with 5 reasons for the current position with stock markets performing what does seem very irrationally by rising too much. And one of the first reasons is that economic data looks back. It doesn't look to the future, it's just looking back. And what you need to factor in is that stock markets always value shares going forward 18 months on average. So although you might have bad economic data today, if the prospects look very good in the future, and let's face it, there's been a huge amount of stimulus packages around the world, so a lot of cash floating around, something known as liquidity, and therefore there's been a bit of what I consider a bit of overconfidence that things are going to return to normal quite soon. I'm not convinced that's totally the case. I think there will be a new normal. Nonetheless, that's the first reason why stock markets have stayed irrationally a bit high. The other reason is it's relative news and relative opinions on news, and that's that normally if there's awful news, you think that would have a big effect on stock markets, but stock markets hate uncertainty more than awful news. So what's happening at the moment, you're getting awful news coming out, but because it's not as bad as was expected, like the US unemployment figures going back a couple of months, there was one day it was announced there was 20 million jobless in the US as a result of coronavirus. That should knock the stock market for 6. But what happened was that the forecasts were expecting 22 million unemployed. So because it was relatively not so awful news, stock markets jumped as a result. I know it's bizarre, but it's true at the moment. We live in an unusual phase in our lives and in history at the moment. So these kind of irrational things are happening all the time. Third reason is that the return you get from bonds, which is corporate bonds or government stocks, the total return, which is made up of capital return and interest, known as the yield, the total return is at or near zero, and in some cases negative. The UK government recently launched government stocks that are projected to produce a negative yield. It's the first time in history they've ever done that. And guess what? There was a huge take-up of it because institutions and banks, for example, have to buy these bonds even if they produce a negative return. Crazy but true. Now the return on bonds is being at or near zero or zero even negative compares very unfavourably to shares, because shares, even though a lot of companies have had to stop paying dividends temporarily, the return from dividends on shares is still going to be around 2 to 3%. Before the crash it was around 4 to 5% in the UK. So that kind of return from shares is driving people to buying shares rather than buying bonds because they're getting a better income from it. So that's the third reason. Fourth reason is corporate profits. Now, the long-term value of a share you buy is based on the future profits of the company, or they're otherwise known as earnings. So you're buying the future earnings or profit stream of the company. That's what you're buying. Now, if you're looking at corporate profits just 1 year ahead, when you think about it logically, that's not that far ahead. So 1 year's profits in isolation, even if it was reduced, shouldn't affect the long-term value of the shares. So for example, one measure of the value of the shares is something known as the price-earnings ratio, which means the share price as a multiple of the earnings or profits of the company. Now, when the profits are, say, 10%, then the share price is 10 times that. That's called a PE ratio of 10. Now, the PE ratio of the market for years has been around about 16, but recently it's gone up to over 20. Now, that's a very small capture of profits for the many years ahead that you're buying the shares for. So don't worry about the short-term effect, in other words. The fifth reason is the monetary and fiscal policy measures that have been brought in. I mentioned the trillions of stimulus package by the US government, but other governments throughout the world are doing similar things, including in the UK. Now, this has brought in a wall of money, which has increased the money in circulation, and that is giving a big boost to shares. So more and more people are buying shares, although not enough to justify the ridiculously high values at the moment, particularly in the US. So my word of caution at the moment is, although there are 5 reasons there explain why markets have risen so much. I still feel that markets are overvalued. I still think it's much more likelihood they could fall. So I would just simply be a bit cautious at the moment, expect a further fall, and then once we get the next fall, there's likely to be a very strong recovery over the subsequent 10 years.